the markets generally lead us in the right direction because it's a discounting mechanism by millions of participants. So generally, over time, the markets price this correctly. So technology is driving that, and that's why we've seen crop prices come low. And I started an agricultural hedge fund at one point because I had the thesis that it was going to go much higher until I learned that was a wrong view, painfully. So the idea is that the people think structurally it's here to stay because of deglobalization, that there's onshoring of activity. So people are going to build factories in the United States and in Europe as opposed to having them in China. I think that's certainly probably true. I also agree that the commodity markets will remain tight for some time because there's underinvestment. But the question to me is the year-on-year rate of change going to be going up, or do prices just remain high? Now, the year-on-year change going up is what generates inflation. I'm not sure we can really generate significant inflation. So my base case is actually inflation goes negative in 18 months and then recovers somewhat back to a normal cycle level. What that means, I don't know, whether that's 3% or 4%, at peak inflation at the top of the cycle, at the top of the business cycle, possibly. But there is a risk to my view that maybe I'm wrong and inflation comes down from 9% where it is today, gets down to 6%, stabilizes here, and then 6% inflation is persistent, and that's a pretty ugly world. I get the arguments. I just think it's difficult to do. And I also think that, generally speaking, if you look at things like, Elon Musk building car factories in the US and Germany, what he's doing is using robots. So as you move the manufacturing back, you're replacing people with robots, which is deflationary. And we can see that in most places. So the robots are taking over the world along with artificial intelligence, and there's pretty much nothing we can do about it because as technology improves, the cost of the technology collapses, and basically everything that's digitized goes to zero in cost over time. There is another structural element, which is the ESG element. So the ESG element is the forcing of adherence to ESG mandates and investment by the European investment community. I think that's like a fiscal super cycle over time. Let's see what the governments do. They'll probably use the recession as a chance to supercharge that narrative as well. So I think there's probably a bubble to come out of kind of green energy plays, because Europe's basically said, okay, we are going to have to move away from this faster than we thought. And therefore Europe, I think, will incentivize even more for companies to start changing and for new technologies to be developed. Now, that kind of narrative can create issues for things like the copper market or the lithium market. I get that too. But that is piecemeal. Now, don't forget, we had a massive demand-led inflation in the 2000s, from like 2000 to 2008, driven by China. So as China came onto the world stage, it consumed enormous amounts of resources. There was a massive demand shock to the world. Commodity prices exploded, but inflation averaged 2.5%, 3%. So it's not clear that inflation is the big thing. You can be a commodity bull, and I think coming out of this, you can probably be a commodity bull and a technology bull at the same time. I don't think it's an either-or situation, but I don't think that prices rise and stay high at a rate of change long enough to create persistent long-term inflation.
I do think that the situation is very different to when China was consuming all those commodities. For a start, supply chains that are supposedly broken down, and for whatever reason, it seems to be nigh on impossible to get them back up and running again. Has that situation changed? Do you anticipate it being able to change fast enough to avert more supply chain issues, also perhaps economically as well?
Yeah, I used to be a real kind of doom and gloomer on a lot of stuff until I really understood technology and the incentive system behind it. And if you've got supernormal profits being driven by issues, by problems, structural problems like supply chains, it is a race to solve them because you capture the supernormal profit. So that's how shale came out. Shale was a technological advance that was revolutionary, that was driven by high oil prices. The $140 oil led to the shale revolution, which led to oil coming back down again, which is why commodity prices tend to be cyclical over time and not structurally higher. And so, yeah, I think the incentivization for this is higher, and also think that supply chains changing may actually be more efficient in the end. So by having less distance travelled, you have less friction points along the way. And if you've got less friction points along the way, sure, the overall level of prices may remain slightly higher because it's slightly costlier to use, let's say, European labour than US labour, or North African labour versus Chinese labour, or whatever it is. Yes, they can remain higher, but again, it's not high commodity prices that cause inflation. It's the rate of change. And even with
yeah,
go on.
Unusually, I think it's not so much the uncertainty in the medium term and long term. I think a lot of trends are fairly clear, but rather from a more acute time frame that there's so much uncertainty.
For sure. I mean, I wrote a tweet thread about this. It's one of the most uncertain, complex macro environments, as you led this conversation with, that any of us have ever lived through. And so there's a lot of probabilistic outcomes. So, I think it's very difficult to ascertain, okay, what is the correct narrative and how persistent is that? The markets generally lead us in the right direction because it's a discounting mechanism by millions of participants. So generally, over time, the markets price this correctly. Now, if inflation was structurally higher, then 5-year break-even rates would be higher than where they are. They're still flirting with, breaking back down below, where are they now? They're at about 2.6%. So 2.6%, that's not very high. That's implying basically that we've got slightly positive real rates, and we've already broken the system with it. So I'm not sure how different this is going to be to other cycles, but I absolutely concede that it's very difficult to get a very high risk reward on it. I'm thinking bonds are about the best risk reward in the macro world right now, but I'm open to being wrong too, because this is a really complex environment.
Well, it seems that, just take any issue in the markets or macro, there seems to be very credible people taking diametrically opposed views about even something as simple as inflation, whether it will persist or suddenly become disinflationary. And as someone who is not a macro expert and doesn't invest his time and energy into analysing all of those factors, it just feels like, and very probably, that any one of those factors goes the wrong way to what you might expect, and suddenly the whole landscape changes. So if inflation suddenly is not contained, that just changes everything else. All your calculations for everything else, markets, interest rates, real estate, unemployment, everything else suddenly is a different calculation. So I'm finding it really, really difficult to come to terms with that. But it does seem to me that everyone is sort of settled on, what the Fed needs to do next. And my understanding from listening to you is that you seem to think the markets have pretty much done the job of the Fed. But when I listen to the Fed, it seems they're hell-bent on continuing to raise. At least they're signalling in that direction further. And they're watching unemployment as their key measure to see if something breaks. What's your take on that?
Yeah, I think they're always behind in the narrative. They're always, by definition, behind the curve because they follow what the curve is saying. And the curve is saying you can probably get to 3% and then you're going to start cutting. So they want to do it because it's a political decision in this day and age as well, to make sure that people don't lose trust in the Fed, because if not, you lose trust in the monetary system. And people are already a bit shaken by what happened. But the bond market itself is saying, well, you're not going to get any further. And the moment you do it, you're going to have to start cutting.